Hey traders, what's going on? Hope you guys are doing good today. This is Chris from VerrilloTrading coming to you with another piece of content. In today's video, we're going to be talking about options trading, and more specifically, I'm going to go into some depth when it comes to certain aspects about how options trade, and basically if you were to go about trading them on a shorter term time frame, certain things that you would need to be watching out for. And I'm going to give you certain pieces of experience or insight that I've gained over time learning how to trade when it comes to options and futures. So a little bit about me. I've been trading since Q2 of 2018. And since then, I've had the chance to experiment with a lot of different trading strategies. Right now, I scalp primarily in the futures market. And in this video, I'm going to explain to you certain problems you're going to experience if you decide to trade options on a shorter term basis, and why futures might be more advantageous for a shorter term scalping strategy. Some of you might already know this stuff, some of you might not. So if you came to this video with an open mind, I just need to remind you that trading options or futures has a lot of risk to it, and you need to trade only with your own risk capital. In this video, there is no recommendation to place any specific trade. In fact, all I'm doing is sharing with you a lot of what I consider to be my own opinions. However, we're going to focus a lot on things related to how the markets actually operate. So I'm going to try to avoid being subjective in any way, shape, or form. And we're going to talk about very specific things relating to trade execution and options trading. So let's get to it. If you enjoyed this content, smash the like button. It helps the channel more than you think. All right, so for this video, I'm going to be using the Interactive Brokers trading platform to do the demonstration, simply because Interactive Brokers is my broker for stock and options trading. And if you're in Canada, for example, Interactive Brokers is one of the most competitive. If you've never heard of Interactive Brokers, that's surprising because they've been around for a long time. However, if you did want to check out their website, there's a link to it down in the description. So let's start it off here. I believe that options have a lot more complications to them than a lot of other products you can choose to trade. And the reason for that is because they are derivative products, meaning that their value is derived from the value of another asset. And second of all, their values also depend on something called implied volatility. So basically what the implied volatility is it's a forecast that the options market has regarding the movement of a specific asset over a specific amount of time. And this implied volatility is priced in to these options already, and it fluctuates on a day-to-day basis. If you do want to know more about that, you need to read about what the Greeks are. Now again, when it comes to options trading, there is a multitude of trading strategies that traders can employ, including spreads, including using options to hedge underlying positions, and simple long option strategies. So for the purpose of this video, I'm going to be focusing on mostly long options trading, because I want to explain to you a lot about how the market operates and why certain options would be more or less ideal to trade for an individual, and some of the risks that they might present to you. All right, traders. Okay, so we're going to talk about liquidity and market trading activity to start here. And I'm going to make you a few comparisons. I'm going to talk to you about how the market operates and why there could be certain risks associated with trading options, especially if they are on an underlying contract that is not being actively traded, or if it's an option contract that is not being actively traded. So this is probably the number one thing you got to watch out for. So again, this is kind of like a checklist that I'm going to give you guys in this video. So I guess this would be the first thing on the checklist. So you want to make sure that you're trading options on an underlying contract that is doing a lot of volume or above average volume. Second to that, you want to make sure that you pick an options contract out of the options chain that is being actively traded. And the reason for this, I'm going to explain it to you now. So think about it like this. You have an options contract, there is a bid and an offer. There's always a quote being displayed for every options contract, because there are what we call DMMs, or designated market makers, who are employed by the exchange to provide a bid and offer almost at all times in the marketplace. So it's their job to provide the quotes. However, it's not necessarily their job to fill you at whatever price you want to get filled at. And this is where it gets a little tricky, because if it's an option that is not trading a lot of volume, there's not a lot of activity on this volume, I can almost guarantee you that if you place a bid on the spread, for example, I want to get filled at these 245s, and the market is an illiquid market that might not be trading a lot of volume, I can guarantee you that you're not going to get filled on the bid or on the offer. You will most probably have to chase the market up, or down in order to land a fill in this contract. And that's one of the risks that is associated with trading something that is considered to be illiquid or is not trading a lot of volume. So as you can see, I'm in a demo account here and I've placed a bid at 245. In a live environment, this order most probably would have been filled at this point. However, right now it's not being filled. So I'm actually going to pull it out temporarily since it's an example anyways. So again, getting back to trading a contract that is being actively traded, this is absolutely crucial if you plan to do any kind of scalping strategy, or if you want to ensure that you are able to get in and out of a trade safely. More importantly, not get trapped into a trade and have to exit at a very undesirable price. A lot of traders don't know this. They just want to trade whatever option on whatever hot stock is out there now. You have to be very careful. So for example, I'm going to bring up a stock that is actively traded, which is the stock Tesla. So now we're going to take a look at the options chain of Tesla. Now, Tesla is a stock that trades a large amount of volume. However, the volume on the options is different from the volume being traded on the actual underlying stock. So if you're going to place an options trade, let's say you want to go long or you want to scalp on a call option or a put option on this stock Tesla, there's a few things you got to watch out for. There are a few ways to determine if the contract is being actively traded. So one way is to just look at your options chain and see which contracts are lighting up and look at the quotes basically. So one thing you guys might know is that if you've used Trader Workstation before, you will know that this is not the default layout for an options chain. In fact, I've changed it. The way you do that is by right clicking and then going to configure layout, and then you can change the columns here. I've only got the volume, open interest, last traded price, and the delta for the purpose of this video. And I believe that this would be a quick way of seeing which options here are being actively traded, because I can actually see the quotes changing as we see the new trades coming in. So we can see that oftentimes the options close to the money are the ones being most actively traded. So I can see the quote here for this 895 call is changing quite a lot. So what I'm going to do is drag that one in to my quote board and take a look at how this one is trading. So first thing we can see here is that the bid and offer spread is quite wide, right around 20 to 25 cents wide. Now, this alone poses a great risk to traders, because if you use a market order, you are immediately going to be offside in the trade by whatever the spread is. So if I submit a market order right now, I'm going to buy it at 710. And if I wanted to immediately get out of that position, I would have to sell it at 690 to this one trader looking to buy it. And now the bids are being pulled a little bit lower. So you can see that the wider the spread of the marketplace, in a way, the higher the risk associated with trading this, because if you have to submit a sell or buy market order to exit a position in the case of an emergency, you're often going to get filled at an undesirable price. This is why the majority of traders would prefer to trade in a contract with a tight bid and offer spread. And that's why, again, a lot of traders move towards trading futures for that purpose. Now, some traders will make the argument and say, I will use a stop limit order instead of a stop order, and this will be aimed at minimizing their risk when the market is getting towards their stop loss area. Instead of using a sell market order and selling to the bid at a potentially undesirable price, they're going to use a stop limit order, which will aim to get a slightly better price there. However, here's the problem. If you're doing business in an options contract that is not doing a steady flow of volume on the bid and on the ask, then you're not going to get filled at the price you want, and you're often going to have to sell at the bid or buy at the ask in order to get filled on a trade. And in the case of an emergency, this is going to result in losing money basically for no reason. So little things like this are things that traders should educate themselves about, and this is kind of why I wanted to make this video, just to point things like this out. So I'll go ahead and say this, is that options contracts are not very good for scalping. And what I mean by scalping is getting quickly in and out of trades, because there is not a consistent enough flow of volume on both sides of the market that will allow for entries and exits at that speed. So for those reasons, I believe that options are not the best instrument out there for scalpers. That does not mean they're impossible to scalp. There could be some scenarios, especially off the open of the market or within the first hour of trading, where certain options contracts are doing higher than average volume. And in these scenarios, it might be possible to take advantage of movement if there is enough volume being transacted on both sides. This layout right here that I created is really simple. It has an options chain, so I can see the quotes for each of the options related to the underlying I'm looking at. In this case, it's triple Qs, which is the NASDAQ ETF. I've got a quote board here, so that way I can drag in the options I want to see their quotes and to see if I have any open positions on these contracts. And then I have a time and sales just to see the volume coming into these contracts. And then finally, I put a book trader here, and this is where I'll be doing trade executions. So I'll give a couple examples of trade executions later in the video if you keep watching. By the way, guys, if you made it this far, smash the like button. It helps a lot. Okay, so let's go on to the next section of this video. We're going to talk a little bit more about contract selection and directional risk. All right, so when it comes to selecting contracts to trade in the options market, there's a few factors that go into it. I would say the first one is the expiry date of the contract. Now, most short-term traders, or call them scalpers or day traders, basically traders who plan to exit this position by the end of the day or maybe even in a few seconds. As I previously mentioned, these traders want to be transacting in the option contract that is doing the most volume consistently on a regular basis. So they're going to go more towards the weekly expiry, so the shorter term expiry options. That being said, in my opinion, there is a certain time period where the options are in an okay area to be traded, and then the closer they get to expiry, they actually become a lot more risky to trade from the long or from the short side. And the reason for that is because the closer the option gets to expiry, the higher the risk that the option can either go to zero or it can go times 1,000 in a really short amount of time. So generally what traders will do is that, for example, let's say you're Monday, Tuesday, Wednesday, you're normally going to be perfectly fine trading the Friday expiry options. Now, the closer you get to Friday, you're going to notice the more volatile the options on the Friday expiry will become. So a lot of traders will switch to the next week expiry on Thursday or Friday, depending on their risk tolerance and depending on the volume being traded on those contracts. And also, one thing I gotta note is the closer the option is to expiry, the more a game of hot potato it is, in the sense that the longer you hold the option, the more likely it is you're going to lose money to time decay in that option contract. The time decay in the option is drastically increasing the closer it gets to expiry. So you're basically playing a game of hot potato. So if you intend to buy it and sell it quickly, you really need a way of having a quick trading execution where you can exit your trade very fast in the case of an emergency. You can also exit the trade at your profit target very quickly as well. All right, a few more notes on contract selection. The options that are at the money, or in other words, options where their strike price is right around where the underlying security is trading. These are the contracts that are going to be doing the most volume on average. Again, there are exceptions, but this is considered to be a standard among options traders, is that most of them look to trade the options that are at the money or a few strike prices away from at the money. And of course, you need to see this yourself. So on the open of the market, you pull up this quote screen and you can see which options are the ones that are actually moving, and also which options are the ones that have the most volume being transacted. And essentially, those are the ones you want to pay attention to, because if you decide to trade, that's the contract that's going to present you with the opportunity to get in and out when it comes to getting paid on your trade, and in the case of an emergency, to get out. So again, I like to keep the last traded price on the options chain just so you can see the trades going through on every option in the chain. Now, that being said, in order to trade these options, I don't believe that this is enough info on this screen right here. I would argue that you would want to see information about the underlying security that you're trading the option on. So for example, if I was going to trade options on the NASDAQ, I would most likely put this over onto my left screen, and on my main screen, I would keep the data regarding the NASDAQ and the S&P 500 futures, and I would look at how the market is trading here, and I would place trades in the options market on my other screen. Now, if I was doing that with a stock, it would be the same thing. I would keep the price of my stock right here, the correlated market right here, and then either off to the side or on the next screen right here, I would place my options execution screen where I would have my options strike prices and have the ladder for trade execution as well. But I'll be honest with you guys, I wouldn't trade options on the NASDAQ because I would rather trade the futures contract itself, simply because it's just better to get in and out of. And it just makes a lot more sense to trade from a liquidity standpoint. By the way, that platform I pulled up was called Sierra Chart. All right, let's talk now about directional risk and how to calculate directional risk in options contracts. So I'm going to reference a formula that is in this book right here, which is Option Volatility and Pricing by Sheldon Natenberg. It's a very popular book among options traders, and it's not exactly a new book either. If you really want to get nerdy when it comes to options trading, you probably want to pick up this book or at least read a few chapters from it. You don't need to go crazy reading about all of the formulas and everything, but there's a few formulas in here that might be able to help you. Now, I'm not really a math expert, so I'm not going to be able to explain to you these formulas on a super deep level. But what I can tell you is that when you have the formula down and you're able to import it into Excel, it will do all the work for you. So I've imported a formula from this book into Excel, and I'm going to show you how it works. Basically, what this formula does now is it calculates what is called the average delta over a price range that I select in an underlying. The reason why we want to calculate the average delta is because delta is not static. Now, the delta is how much the price of the option or the premium is going to change based on a $1 movement up or down in the underlying stock. So for example, this contract here, these 377 calls, have a delta of 0.49. I'm going to round it off. This means that if triple Qs go from 377 to 378, or if they basically just go up or down by a point or a dollar, then the premium of this option right now, which is at last traded at 105, will go up by 49 cents per contract. However, this is the issue. When the NASDAQ or the triple Qs moves up a point, this delta here will no longer be at 49. Because the delta doesn't stay the same. It's not static. And that's an issue that we need to overcome. So there's another input that helps us measure directional risk, which is the gamma. And the gamma is essentially the rate of change of delta. So it's the acceleration rate of delta. Basically, you need to incorporate both the delta and the gamma into the formula to get a better calculation of what the directional risk is going to be if the stock moves up or down by the amount you choose. So guys, I can place this formula for you guys in the description of the video. That's no problem. I'm going to show you how it works now. So basically what you need to do is you need to input the three values into the formula, and then it's going to spit out a number, and it's going to tell you by how much this options contract is going to move. I'm going to start with the risk. So for whatever stock you're watching, you just need to put in a value here based on the movement of that stock. So if you want to know, for example, for every $1 move the stock makes, how much is my option contract going to increase or decrease in value? That's what this formula is going to be used for. So I put a 1 there just to keep it simple. Now we need to input the delta and the gamma for our specific options contract. Now, to keep things consistent, I'm going to use the 377 call option here. And we can see that on this option, the delta is 48 now, so I'll round it off to 48. I'll put 48. And the gamma is 0.165, so I'll put that into the gamma. And now the formula is telling us that if the NASDAQ moves up or down by a point, the premium of this option is going to change by 56 cents per contract. Options contracts have a multiplier of 100, so you do know that 56 cents is actually $56 per contract. So that's basically how you calculate the directional risk. Now, this can be used to set up limit profit taking orders. It can also be used to determine where you have to place your stop loss. It can also be used to determine how far away you would like to place your orders to potentially buy or sell a contract. Now, another thing I might mention is that since this is only incorporating the directional risk of the contract, it's not actually the whole entire puzzle when it comes to the pricing of these options. Another thing you need to know is that options prices also move based on fluctuations in volatility. So if the market opens and it's very volatile, these options will be priced a little bit higher. And then all of a sudden, if the market volatility or the average ebb and flow of the current market environment, that's what I consider to be the volatility. All of a sudden, if we see the volatility conditions drop, you will notice that the premiums of the options will also lose some value because of that. So even if we calculate our directional risk properly, there could be other factors that change the prices of these premiums. So this is why I believe that trading options is a lot more like a game of hot potato than anything. You really don't want to be stuck holding the hot potato because you're going to get burned pretty easily. Now, to finish off this video, I'm going to discuss some execution techniques when it comes to trading these options and how you would go about trading them and how I would go about executing these trades on an options contract. So I'll just give a hypothetical example here. Let's say I wanted to trade on one of these options here, potentially a 376 call. I know I switch contracts a lot, but again, remember, we have to be trading the options that are transacting the most volume. Now, since we're 15 minutes here to our market close, I don't see much volume trading here. As you can see, the last contract traded up here at 165. Now we've had 12 of them trade at 161, and we're actually seeing a little bit of volume come in here now. Now, like I told you guys previously, you definitely need to be informing yourself about what the underlying market is doing if you're going to be trading an option. I would never execute a trade only informing myself with this information right here. Let's say, for example, I wanted to submit a bid or a buy order in the market. So I'll submit a limit buy order simply by clicking on the price ladder. And you can see that with this order, I already have an attached stop in the case of an emergency. And if I scroll up a little bit higher, I also have an attached target in the case that the market goes in my favor here. This is basically what you would call a bracket order. And if you want to know about how to set up a bracket order, I do have videos on that on TWS, so you can check those out. Now, for example, let's say I didn't want to trade here anymore. I can simply cancel that order out with a button. You very much would like to have a button set to cancel your order in the case that you want to change your mind and you don't want to trade there anymore. Now, a few other things about trade execution in the book trader on TWS. Again, I believe this is the fastest way to execute trades, simply because if you want to enter the trade, you click on one side. If you want to exit the trade, you click on the other. And since this is an option, I'm not going to sell one before buying one, because initiating a short position in an option has its own risks entirely, not like a futures contract where it's just based on directional risk. So let's say, for example, I wanted to enter into a trade here. So let's actually try and get filled on an order at this bid at 163. All right, so I've been filled on this trade right here at 163, and this is a demo environment, so you will always not get a realistic fill in a demo environment. That's just how it works. Unless you're using a more sophisticated simulated trading service, like for example, Sierra Chart has one that's pretty good. So for example, I have my attached stop and my attached limit here. Now, one thing to note here, this might be a quirk with TWS, but I'm not actually able to click and drag these orders, these attached orders here. So I can't actually move my limit order to any other price here. And this is a little bit problematic, I must say, because if I wanted to, for example, click to exit the trade right now and try to get filled on the offer right there at that price, I can submit an additional limit order here to try and sell this trade. And I'm going to try and do that now before it hits my stop loss. So I've actually been filled on that exit, but now as you can see, the attached stop and limit orders that I had with my previous trade are still in the marketplace, and I can cancel them now with a separate button. However, that is quite problematic, I would have to say. So there might be ways around this. Let's say, for example, you were in a position already and you didn't have any attached orders on that trade. You can simply submit the stop yourself at a lower price by configuring that in the book trader. So now I've created a sell stop order at this price. Actually, it's a stop limit. I would advise to be careful using stop limit orders, because I've been in situations trading options in the past where my limit order has been skipped and I had to get out at a very undesirable price, or you end up totally getting trapped in a trade. So since then, I would say be careful using stop limit orders. But again, if you're trading an option with a super wide spread, then that might be your only option. Now, I would say the disadvantage of trading without attached orders is the fact that in the case of a drastic move against you immediately as soon as you enter the trade, you might not be fast enough to submit that stop loss right away. And the second thing is, if you decide to exit the trade sooner, you can't move your attached target. You just have to create a new one, which might mess up your margin requirements. For example, if you're trading a smaller than average account, you might not actually have the margin to submit 2 sell limit orders for that option contract. So in which case you would simply have to cancel your existing profit taker and just submit a new one. all of what I just said here, guys, is to be practiced by yourself in a demo environment first. Make sure that if you're using attached orders that they're working correctly. And you should never trade live on a trading platform if you're not comfortable with the order execution and moving orders, submitting orders, canceling orders, exiting trades for emergencies, etc. You want to gain some facility when it comes to this stuff before trading in a live environment. Now, there are other tools or platforms out there, and I'm going to use the example of Sierra Chart here. If you needed a platform that will offer you more advanced ways to execute trades and more advanced order types, like for example, limit chase orders or stop orders that trail based on a step movement in the market, or basically just easier ways to move your orders around, then you can consider a more advanced tool like Sierra Chart, because Sierra Chart does connect to Interactive Brokers and you can trade and execute options contracts from your IB account in Sierra Chart. Some of those advantages include moving attached orders, for example, one tick up, one tick down. And then for example, if you're in a trade, like here, I can also move my existing orders with the press of a button. I can move my stop order with the press of a button as well. So there are certain advantages to using more advanced trading tools, but again, there are other costs associated with using more advanced trading tools also, okay? So I just wanted to put that out there, guys. Remember that trading is risk activity, and none of what I shared with you in this video is any advice to trade. All of it is for informational purposes only, and because I enjoy making tutorials. So if you found this video helpful, guys, remember to let me know in the comments below, leave a like on the video, and I'll catch you in the next one. Take care, bye.